As usual on a Friday, I'm just wrapped up doing the premium video for the good folks in the gold room. And what we do is we looked at the indices, we looked at the bond market, we looked at the dollar, and we try to weigh the risk to reward that's out there going into next week. So going into next week, you have Powell on Wednesday, and then you have this little startup company reporting earnings called Apple, I think. So two pretty big events, if you will, going into next week. Really, all we can do is just kind of look at the lay of the land and then kind of understand the risk to reward that's present to us right now. So what I'm going to do here with you guys on the YouTubes is just cover SPY, because this kind of goes back to what we covered last week. They gave you a level to keep an eye out for on SPY, and we actually have breached that level. And then I'm going to show you a piece of the bond market that I'm looking at, not the whole bond market, but just a piece. And then we'll tie those two, and I'll show you the IWM. So I'll show you three things, and we'll kind of weigh the risk to reward here. So last week we were talking about this retracement level. If you're in a retracement on the SPY from the high to the low, your 50% retracement, that's a really straight line. Considering I'm drawing that with my trackpad with a free hand, that's a really straight line. The 50% retracement of the entire rally, or the bear market, is 414 on SPY. So there's actually a little bit of a level here between 414 and 415. So kind of a big level there for a lot of reasons. Fibonacci, moving average there, previous high right here. So whether you look at structure, moving averages, or Fibonacci, whatever dojo you attend, they all line up there at 414, 415. And we did actually manage to close above it this week. And it happened on relatively decent volume as well. So that's always a bonus. So this looks relatively decent to me. This is an improvement from last week. The squeeze continues to fire long. It's only 2 dots into the squeeze firing, so usually those get 8 to 10. I wouldn't necessarily look for, a massive move from here, but at least this keeps it on the right side. This is neutrally bullish because the green is below the red, but both are above 50, so it can't be full bull, but it is neutral bull. And whenever you hear neutral, you then have to have thrust from your high-low pro, and you've had that basically since right about there. So if you look at the weekly chart, that looks perfectly fine to me. The daily chart is certainly starting to set up as well. So this is more bullish than it was over here on the weekly. You actually have both lines above 50, green above the red. And then you can see here that really hasn't happened all that much. There was a little blip here, but it was erased immediately. So that's a significant signal. Structure is fine. You have green, blue, red. 2150, 200. That gets a check. This gets a check. You have thrust. That's the last signal. Up thrust. That gets a check. And you have a squeeze. So that gets a check. So generally speaking, this chart is a chart that should try to break out. In most instances, you have almost full alignment here. It's not perfect, but it's as good as it can be given the situation. Between the weekly and the daily, you have alignment between your structure and your momentum, and you have a daily squeeze. So there's a pretty high probability that would try to break long. So that's the good. Let's see if we can take a look at the not so good. And everything we just covered on SPY applies to the QQQ as well. It's just the QQQ is stronger in the near term. So this is the IWM, and this is the not so good. This is the not so good. So we'll just quickly do the same thing we did on SPY, just so you can kind of understand the process. Always start with the price, right? Try to understand what the price is telling you. Here the price is bearish because you're below the 200. The 50 is crossed bearishly, and then the 21 is below that. So you have green, blue, red in a bearish fashion. At the absolute best, you would say that this is just bearishly neutral. But you could technically also say it's just straight up bearish. Maybe bearishly neutral is a little bit more accurate, because if you look at the trend oscillator here, it's not full bear. The red line is still above 50, but the green is below 50 and very much below the red. So that's bearishly neutral. So not really a lot here. And then if you look at the daily chart, it's almost, the daily chart's full bear, right? Because you have the 21, the 50, and then the 200. That's a bearish stack. The 200 is on top. The 21 is at the bottom. That's bearish. This confirms that it's bearish because both lines are below 50, and you have active thrust lower down here, as well as your obligatory squeeze. So this would be the bad, right? This is, if the SPY was the good, this is the bad. And we have to kind of have a way to break the tie, right? Because we have to ask ourselves, well, in a perfect clean market, you have all the indexes kind of telling you one thing, and at least right now, the IWM is kind of telling you something different. Now, of course, it's subject to the difference because of the amount of small banks that are in IWM and the lack of technology, which has been what's been running the market. So it does make some sense, but this is a pretty wild divergence here between the two. So in order to break the tie, and we would still, even if we had a perfect tie, we weren't looking at HYG, which we'll look at here in just a sec, we would still skew it more bullish because not only is the SPY look neutral bull to bull, but then the QQQ actually looks bullish, and the DIA looks neutral bull as well. So it really is only the IWM that's kind of the outlier. But let's break the tie using the bond market. So for the bond market, I'm going to show you HYG here. This is high yield bonds, junk bonds. And again, I don't trade this, but I look at this as a major and important signal for markets. And what you want to see here with HYG is just very simple if you're bullish. You want to see this up on up days. So, the market had a healthy day yesterday, this was up, that's good. It had a healthy day today, this is up, that's good. What you don't want to see, and it would be a very large warning sign if it persisted, but we haven't seen it, but it would be, is if the market was green and the HYG was consistently red. That would be a big warning sign. So that's kind of what we're looking at here, just to see if from a structural perspective this is more skewing bullish or more skewing bearish. And as it sits, the weekly chart is pretty neutral. It is starting to improve, but this is still bearish. And then this is kind of neutralized a little bit by the upthrust. So you have a bear trend, but you have thrust at the bottom. So what does that mean? It's kind of like hot and cold water. You put them together, you end up with room temperature water. So it doesn't really tell us that much. But it is generally what you want to see, right? Having thrust up is absolutely important if you're going to fix this eventually. So if you look at the daily chart, you kind of have a little bit of a bull flag here, right? However you want to slice that. And if this were to break higher, and I would say probably does based on the setup here, that would actually confirm what we're seeing more so in the SPY, and would probably take the IWM up higher with the market kicking and screaming. So do I personally want to be trading the IWM? Not really. I think there's a lot of headaches there that can be avoided by just trading the SPY. Because the SPY has the technology component, and if the banks get some positive news flow or energy companies, which are dominant in IWM, then you'll get it in SPY anyways. So I don't see a personal edge in trading IWM, but in terms of the three things that we've looked at, the SPY was the good, the IWM was the bad, and HYG in this case, junk bonds, breaks the tie, and it leans the odds and the probabilities towards the bulls to push into next week, potentially right after Powell, and see what they can do with that daily squeeze. All right, guys, so that kind of breaks it all down. Hopefully all that makes sense. No stock picks this week. Just really focusing on what I think is most important going into a Fed meeting. We'll try to have some stock picks for you next week once things shake out. But the main thing that I wanted to share with you guys on the YouTube today was just looking at two indices that are telling us two different things, and then finding a way to break the tie between the two using the bond market. And I continue to think it's a pretty good signal. So catch you guys next Friday. Thanks for stopping by. Leave us a like before you go somewhere else on the YouTubes. We certainly appreciate it. We do it for the algorithm more so than us. It lets people know that you found value in our content. So we certainly appreciate it. Thanks for stopping by, and I'll catch you guys next Friday. Cheers. Hey traders, this is Sam with Simpler Trading. I want to thank you for watching today's video. Hopefully you found the information in it helpful. If you did, leave us a like, leave us a comment. It really does help us out with the algorithm.
And if you want to see us trade live with our own real money and be part of the community, come and check us out at simplertrading.com.